What's up, guys? This is James Anderson. I'm back here with you guys again. It is August 9th on a lovely Saturday. We're just finishing up working here. We just wanted to kind of talk to you guys about a couple things. Of course, first and foremost of all, you can make sure you go to my Facebook page, JD Anderson, JDA Solutions. And then I got my Twitter handle down there for you, at I am JD Anderson. This is Mr. John Pettifordale. As always, he's with me, Platinum EVP. What's your Facebook page, John?
John Pettifordale.
Okay, make sure you guys go like his page. You got awesome content talking about finance and this thing that we like to call personal financial success. So we're about to get right back into it because there's a couple of things that I saw out here online, man, and it was really alarming to me. I saw some articles out here on a couple of big websites. I won't say what the names are, but I will tell you this: it begins with an F, and it's one of the top business magazines out there. Now, here's the deal. When I see things come across, I'm always out there looking and probing for things, and I pull information about finances, I look them over, and it's very rarely that you'll catch me speaking about an article. But here's the deal. I think we have to address this, man, because I think, my opinion, I'm going to get your input.
Okay.
This might be some not so great information that the general public should be using. So the first article we got here, it says, you can retire sooner than you think, parentheses, maybe.
Mm-hmm. I did read that article.
You did check that one out. Okay. So you got a little bit of background in it. Now here's the deal, man. In the article it kind of states really quickly. It says that people can retire sooner than they think, basically if they can follow the TSL approach. And what's TSL? TSL stands for Taxes, Savings, Life. And it represents a percentage breakdown of your gross income. So the person that supplied this article, who they're speaking to, recommended a 30-20 ratio. So that's 30 goes to taxes, 20 goes to savings through a 401k type plan or paying down debt, and then 50% is life. So that's your housing, food, fun, entertainment, and all that stuff like that. Now, what's your thoughts on this TSL reference? Is this 30-20-50 ratio?
Okay, well, first of all, I don't think a person should pay more in taxes than they do themselves. You should save more for yourself than you pay in taxes, okay? And you can, what a person has to understand is they can control that, okay? By the strategies that we teach, obviously the tax minimization, personal financial success system at Myecon, we can show a person how to get down to 12, 15, 20%, or maybe even 5% of their income in taxes. And then I would say if you're going to invest, then yes, it should be 10, 15, 20%. But it definitely shouldn't be an adverse ratio where you taking care of the government's economy better than you taking care of your economy.
Okay, so really, and that's what my approach was when I read it. I'm like, well, TSL, mind you, this is just my opinion. I'm like, why shouldn't it be savings, life, then taxes? I mean, I got to pay everybody else out before we start talking about starting producing some things for ourselves. And you think that's kind of an adverse effect? They will name it TSL and make sure the taxes is up front?
Well, they took it from the standpoint of everybody is just going to be in what I call the lesser denominator of how taxes should really work. Because the tax code in this country is preference toward business owners, okay? This is really towards somebody who really is not a person that's trying to really change their life financially with taxes. Because think about it. In the average world, you would work first, then you'll pay taxes, then you pay expenses.
Right.
But what we teach people is how to flip that around. They work, then they pay expenses, and then they pay taxes on anything left. Well, those are two entirely different worlds.
Two exactly entirely different
So
worlds.
when you look at that, these numbers can be much different in a ratio if you just go to the other side and understand the tax advantage of a home-based business.
Okay, so what we're stating right here in this article, he's just basically firing this out there to generic population and things like that, and it's not ideal for a person, obviously, because you don't want the ratios to be more in your favor. But he's saying that 30, 20, 50, you can retire sooner than you think. Parentheses, maybe. Well, let's move on to the next point he got in here, man. He states down here below, he says, the interviewer is asking a question. He says, you say that one of the ways to retire sooner than you think is to have at least 2 or 3 sources of income in retirement. And then they ask why. He said, people always talk about diversification for investing, but they don't talk about the importance of diverse income streams in retirement. You have one big river income throughout your working life. Retirement is more about getting different tributaries to run into and create a decent stream of one income. That way, if something's go wrong with one, you have others left over.
Mm-hmm.
So, what are your feelings about like multiple streams of income? And some people call it drips. And is there really a need for it in retirement?
Yes. Well, first of all, I would say a person needs to have multiple streams of income, not only at retirement, but while they're working.
Okay.
I say people should build their plan B while they don't need the plan B. So if they're going to work a job full time, they should have a home-based business part-time that will bring in another separate income, and it should keep the components of leverage and residual inside that home-based business. That means getting paid off not only what you do, but what other people do, and residual income is expending effort one time and getting paid multiple times for it. Well, when you got those things going on, so now you've kind of fixed your situation during the working years.
Oh, yeah.
And then what we also teach is, okay, if we cut taxes by 30, 40, 50%, take that and start knocking out debt and then start investing, well, we're building two streams of income for retirement. The home-based business is a stream of income.
Okay.
Then we would also have our Social Security, if we do get some of that. And then we would also have an investment portfolio, which would be three separate streams of income.
Okay. So you got three key components fueling the retirement.
Correct.
But when you get to that day, whatever that day is for people, when they're looking to stop working.
Correct.
Okay. Cool. Well, I mean, I think that would sound like a good deal to me. I mean, people would have to see it in order to believe it, but I really think that's a good deal to start moving towards that. But I'm going to back you up just a little bit right here.
Okay.
Because you keep talking about tax refunds and cutting taxes and minimizing taxes.
Okay.
But Huffington Post posted an article, and I remember this article, and I wanted to make sure I bring it into the discussion. This was probably around like January when this went up in 2014. It says, big tax refunds really are good.
Okay.
So, before we get into the article, what about the title? Tell me about what you think about that right there.
I think the title is very misleading. Okay, and we'll get into the details about that, but I think it's a very misleading title.
Very misleading title. Now, mind you, this is the Huffington Post business. And you're saying that this title, big tax refunds, really are good, is misleading.
I think it's misleading, yes.
Okay. All right. Well, let me read a couple points from here. So basically, it's an executive of a company. He basically wrote this article. I won't put any names out here, but he's basically saying that over 25 years of his experience, he's saying that big tax refunds are really good. He said the average federal income tax refund over the last several years is almost $3,000. In my opinion, getting a $3,000 check is never a bad thing.
Okay. Well, I would say this. Yes, getting a $3,000 check would be good, but if you are getting a $3,000 check in lieu of you putting things on the credit card all throughout the year because you had very limited cash flow, that's a bad thing. Because obviously, if you have payments on debt throughout the year, you not only are losing what you paid on the debt, you're losing all future earnings. I mean, on the money, but you're losing all future earnings of whatever you give the finance company. So if you gave the credit card company $1,000 to $2,000 throughout the year, that $1,000 could turn into, over the next 15 years before you retire, maybe $15,000, $16,000 every time you did it. Well, if you did that for 2 or 3 years, you've given them $30,000, $45,000 really in cash flow, and so you can get a check for $3,000 every year. It doesn't make sense.
It's upside down.
Absolutely.
Okay, I got you. Now, point 3 says, since interest rates on savings accounts average about 1% per year and have done so for many years, you're really not missing out on any extra money in savings. If you divide your refund by 12 months a year, let's call it $3,000 that he's saying that you'll be getting back, that gives you $250 a month. If you put the $250 a month in the savings account throughout the year, you will earn about $15 total for that year. He's basing off of 1%. You can earn a bit more if you had a rocket stock fund or the like. However, that is speculative at best. So while saving money is a critical best financial practice, the act of doing it every paycheck or once a year is not so important as finding a way that it works for you.
Okay. First of all, why would a person save money in a savings account? What we got to understand is a savings account is a marketing pitch.
Okay.
It's a sales tool. It's a sales pitch. It's not really where you should be saving money. But we have to understand in capitalism, everybody is your competition for your money.
Okay.
So
I like that. Everybody's your competition for your money.
So the bank will tell you, well, come on down, bring your money to us. We love you. Don't put it in the market. It's very risky out there. Please don't do that. We love you. Come on down, bring your money. And then they'll give you 1%. Well, anytime somebody is going to give you money unsolicited, it might be a bad deal for you. You got to figure out, why do they love you so much?
To give you some free money.
Give you some free money.
Okay.
Now, so that's the first thing. I don't think a person should save money in a savings account.
Mm-hmm.
That's really just more of a put and take account. You put some money in there, you take it out, do something with it. It's not for savings. If you're going to save money, it should be saved in some type of vehicle that will give you 8, 9, 10, or 12% rate of return.
Okay.
Not 1%. So, yes, while he is true, said if you put money in a savings account, you get $15. But that would be where I would say put your money. You should take the $2,000 or take $3,000 a year to $250 a month and drop it into the 401k.
Mm-hmm.
If you put $3,000 into the 401k, it'll save you about $1,000 on taxes. Well, a penny saved is a what?
It's a penny earned.
So now, So it saved you $1,000 on taxes. Number one. Number two, it's going to grow what is called tax deferred. You're not even going to have to pay taxes on the growth of it until you pull the money out later on down the road. And if you have a home-based business, that could be very little taxes.
Okay. So we tied it all in on the front end and the back end.
Right.
Okay. I got you. Now, point 5 is one that really I was kind of blown away with what this kind of said. But some parts I agree with it, some parts I don't agree with it. Let me read it to you.
Okay.
It said a big refund for some taxpayers. One example of government assistance programs getting money to those who need it. Between 40% and 50% of households pay no federal income taxes in the last 4 years. In 2013, approximately 43% paid no federal income taxes due to low income or income from non-taxable sources such as Social Security or government assistance, obviously.
Okay.
The Earned Income Tax Credit, the Child Tax Credit are available to those individuals and families who are working and who have a low income, and the credit most often creates a big tax refund. These taxpayers are unable to keep this money throughout the year since they don't have it until they file.
Okay.
Now, I know that, of course, if you have low incomes, you get the Earned Income Tax Credit, Child Tax Credit. That's fine. I agree with that part. But what is your opinion of him saying that the government assistance program is getting to those who need it?
Okay, well, that's fine. My deal is this. First of all, it's not your responsibility to fix their economy.
Mm-hmm.
It's America's responsibility to take care of that. You got enough job trying to deal with your very own economy. You can't take care of these people's economy. That's not your responsibility. So what I would say is you should get your money so you can help fix your economy. Because remember, America's idea of getting fixed and your idea of getting fixed is two different things.
What's that?
Well, I remember when George Bush, he was actually in office. George Bush, the second George Bush.
Mm-hmm.
He sent everybody $400 in what is called a tax rebate or whatever.
Yeah, the stimulus or whatever.
Right. So they got everybody got $400, and he said to help spur the American economy, go take this money and spend it. So take the money and buy a TV. Take the money and buy something.
Yeah, everybody's buying everything.
Right, because our economy is based on consumer spending.
Mm-hmm.
Okay. Well, the problem with that is if you are in debt, got very little money, you don't need to take that $400 and take it and spend it. You need to take it and pay down some of your debt, or put it in your 401k and save it for a future rainy day.
Mm-hmm.
Well, their idea of getting fixed is different from your idea of getting fixed. So you got to make sure you're taking care of your economy, not the American economy.
Okay.
It's not your responsibility. So I wouldn't make that my problem and say, okay, well, they need this money to
help everybody
else. Okay, because if that's really how it was, everybody in America would have the same tax code, and they don't.
We know that's true.
Right, based on where you get your income from, it's taxed differently.
Mm-hmm.
If you work slave to the bone, you tax the highest. If you have a business, you can get your income taxes way down. And if you mess around and go all the way over to making your money with money, just strategy, then the max you can get taxed on is about 15%. Mm-hmm. And then if you got that in a business and you got tax deductions, that can go all the way down to just about 0. See, many people wonder why Mitt Romney, and I'm not a Democrat nor Republican, I don't care one way or the other, but they wonder why Mitt Romney paid 13% of his income in taxes.
Everybody was saying he should pay more in taxes and things like that.
He only paid that much because he wanted to pay that much because he knew he was running for president.
Okay.
So he could have got that way down, but he knew that would look bad to the average American person that does not understand.
So you saying that he paid like, what was it?
13%. 13%.
So
everybody, $30 million.
So everybody was upset about his 13%. That was 30. I mean, really 13%, 30 million. 30 million is a lot of money, but everybody was upset that he had. In case you guys don't remember, people were upset with Mitt because he had a really, really low tax bracket, and a lot of individuals, you know, they would say was because he was a Republican and he was conservative and he should pay more taxes, and it was all these things like that. But what you're saying is this: Mitt Romney paid 13% because he understood really what was going on.
Correct.
And the only reason why he did it is just to save face to all other voters. Because you're saying he could have went down to zero? Is that what you're saying?
Correct. He could have got his income way down to zero because a lot of people don't understand this. If the government wants you to do something, they write laws, especially in the tax code, to influence you to do it. Okay, let me give you some examples. The first example is if you rent a home and you buy a home, which one actually gives you the bigger tax advantage? You get a bigger tax advantage for buying a home because you have to pay mortgage interest. They let you write off what is called mortgage interest. Well, the government did that because they wanted people to buy homes. They wanted to spur home growth in America.
Yeah.
Okay? Let me give you another example. If you buy a Toyota Prius or the Nissan Leaf, those are basically called going green kind of
the green
products.
vehicles.
Green vehicles, okay?
Yeah.
They give you a $7,500 tax credit going towards your tax bill if you buy one. Why? Because they want you to buy one. Everything that the government wants you to do, they give you a tax deduction for doing it. So this guy here, first of all, he has a skewed viewpoint. He runs a tax service. He gets paid on you having a big refund, so he can charge you $300 or $400 on what is called a refund anticipation loan. So he makes more money based on your ignorance of this fact.
Yeah.
That's the first problem.
Yeah, true.
Okay. Then, if a person has a business, the government wants us to go into business. They want us to have tax advantages. You get over 400 plus tax deductions for going into business that you don't get as an employee. When I understood that, I cut my taxes down, way down below 5%. And you can do that too. So the bottom line is, yes, a person should save on taxes, but getting a refund don't mean you saving on taxes. It means you overpaid. Now what I say is you should get that money, $200, $300, $400, $500, $600 a month. Take that money and strategically knock out debt. Now here's another reason why. Let's say that I was normally getting a $5,000 refund. I've been taught and conditioned that, woo, that's good, that's great.
Yeah, I mean, you have a couple kids, you know, you got a lower income, you can get $5K. That's not bad.
Right, so I'm feeling good, and everybody. So we've been taught in society, whoa, that's a great thing.
Yeah, you got a big refund.
Right, but let me show you something. If you took that $5,000 and dropped it into your 401k, and you were gonna retire, say in 15 years, at $5,000, that $5,000 would turn to $19,190. So you didn't just really let them hold on to $5,000. You also lost the earnings of what that money could become. You could have taken that money and invested it in the 401k. Also, when you invested in 401k, you would have got another $1,250 tax deduction.
Yeah, so tax deferred account.
Right. So if you did that in 10 years, you would actually save on taxes $12,000.
Okay.
By having a home-based business. And then obviously that $5,000 over a 10-year period would have turned to, you put $50,000 in, but it would turn to $191,000. That's the economy that you need to be fixing. You don't need to be fixing, trying to make sure they got money for the program. No, that's their job to do that. Your job is to make sure your economy is fixed. And I think most Americans have forgotten that it's their responsibility to fix their economy.
Yeah, okay.
Because what they do is they say, well, let's elect...
That might be some harsh words, man, but come on now.
Okay, so what happens, they say, well, we need to elect the right one in.
Okay.
You're not going to elect the right one in. It's never going to happen. Neither one of them got your best interest at heart. Because you can look at the last 25 years and see Democrats in office. You can see Republicans in office. And both of them did about the same thing. Okay. And they all had you sitting there with both. Nothing going on. So what I would say is don't worry about if it's a Democrat. Don't worry about if it's a Republican. You just worry about your economy. That's why we call our company Myecon.
Great, man. Well, that's fantastic, guys. You said a mouthful, man, in this one, but we're going to keep it going, dude. Again, guys, we're about to wrap it up. I'm JD Anderson, JDA Solutions. You can check me out on Facebook. This is Mr. John Pettifordale. Check him out on Facebook. I know he got tons of good content on his site. Hit me on Twitter. I am JD Anderson. And, guys, we're going to finish wrapping it up on this Saturday. We've been having a good time. We got some stuff going on and just working on doing this thing that we like to call personal financial success. So, like us on YouTube. Subscribe to the channel. Everything is going to be out there. We keep it wide open. And if you guys got any comments, drop them down below. If you got something to say, feel free to hit us up, and we're going to be doing what we do, man. Thanks a lot, John, for taking the time, man. I appreciate it again.
Right. Thank you.
And we'll see you next time.